What if I told you you could, with relative accuracy, predict what the market is going to do months and even years into the future? For those of you who have been following my channel, you know what this red line represents, but as I've dug even deeper into the charts, I may have discovered just as significant of a trend line. Tonight's market meolysis is going to be short and sweet, covering crucial multi-year levels on SPY, QQQ, and Nvidia, and teaching some of the best charting skills that have taken me years to develop. If you missed the broader market analysis that I provided last week that included a startling discovery about Bitcoin and the overall markets, please check out that video linked above. Then come back to this video for insights you won't want to miss. When you're charting multi-year levels, you have to be extremely precise. And we may draw our main resistance line either starting from October of 2007 or around July of 2008, depending on what I'm about to show you. Over the weekend, I was updating my charts on Moomoo, and I noticed that this line appears to top out at around 630 on Moomoo, not the roughly 603 I had noted on this chart. And it made me realize there may be an alternative way to interpret this resistance line. On SPX, the range for this resistance line could be somewhere between around 6050 and 6500, depending on how you draw that resistance line. Initially, I had drawn this main resistance line starting from the beginning of this bear market. But notice how we can actually draw a trend line that separates the price action here, then acts as an impenetrable resistance as you get over to here, and you notice right here the price cannot get above that level. And notice also how this line is essentially parallel with this main support on the bottom, essentially creating an ascending channel that's lasted all the way since 2007. I don't think it's just a coincidence that the market had this very sharp pullback starting on November 11th, 2024, when it touched this red resistance line that we've been covering. But there is the very real possibility that this alternate resistance line here in blue may hold even more significance, assuming that this red line gets broken. And we could see the market come up to that blue resistance as it converges with the main yellow resistance of the channel that I covered in my last video. Just as you can see how as this came up, it eventually does converge with the channel. Also note how the support and the resistance on the RSI on the weekly time frame matches up with these touch points. Here, here, there, here, here, and there, and here. As I previously shared, the charts seem to be indicating that the market wants to continue higher, but we may see an alarming increase in volatility and swings in the weeks and months to come. And this does not exclude the possibility of roughly 5 to 8% corrections at a time. Like, look at this. You could come up to around 620, come back down to 575, 644, back down to 600, back and forth, back and forth. We are going to very likely see this coiling in volatility if this pattern holds up. And I don't think it's just a coincidence that the roughly 70 to 80% completion of this RSI pattern lines up with the double main resistance on the chart up here. You can draw a line just about anywhere and find touch points. What matters is that it's the line of best fit, and price action respects it as support or resistance. Technical analysis should be objective, but can be subjective if you're subconsciously looking for levels that confirm your thesis. You have to guard against this and periodically update your chart as price action develops. To remain objective, only lines of best fit should be charted. And you always have to be open to new possibilities. The job of every chartist, so to speak, with technical analysis is to identify seemingly hidden patterns and trends. Do you include the wicks or only the closes? The longer you chart, the better you're going to get at it. Chart patterns aren't always neat and tidy, and they don't always fit neatly inside of a box. Sometimes you have false breakouts and breakdowns before the real move. The market expresses itself in geometry. There is a reason that shapes and Fibonacci levels work so well. Look at that 61.8 right there. Also keep in mind what type of pattern you're looking at, whether it's bearish or bullish versus what market you're actually in. In bull markets, bearish patterns don't always play out, or don't play out to their target, and vice versa in bear markets. Sentiment matters. Build your charts one line at a time. Extended lines can often retain significance, and the first touch of a key level is always going to be the highest probability for a successful trade. And I will say, you are not a trader until you've had your first loss. But if you're doing things right, you should be learning 3 times as much from each loss than each win. If you feel like I'm sharing trading secrets that Wall Street doesn't want you to know, please take a few seconds to like and share this video. It's totally free and helps me so much. And if you don't want to miss out on these market insights, those subscribe and notification buttons are only a click away. Switching over to QQQ, I really love the 4-hour time frame because you can see all extended hours price action pre and post market. You're essentially getting the whole picture. Charting is whatever you want to make it. Do you want all different color lines with different thicknesses for different significance levels? Or do you want all the same color lines and the same thickness? At the end of the day, it's whatever works for you, as long as you can consistently make money. Your line should make the most sense of the chart, and objectively, that should involve the most touch points. Take this chart pattern as an example right here. We had at least 4 touch points of resistance and multiple touch points of support as well. And see how it played out perfectly. Lines on a chart can equate to thousands of dollars, so make them count. Try your best to make sure that price is actually rejecting off of the level that you've just identified and not some other level. Like this right here, we had this main resistance, but there's also a horizontal resistance line there. One could argue that it's bouncing down off of either one of those. And it's your job as a technician to figure out which one is the most accurate. It's also very important to ensure that you use colors that don't blend in with your candles. I use traditional red and green candles, but some prefer to use white and yellow, etc. due to psychological effects of colors. A lot of times my trend lines are drawn with purple because they really don't blend in with the actual candles. You have to keep in mind that no charting is perfect. Partly due to the fact that charts even between platforms differ. It matters whether you're using logarithmic or linear skill. And this becomes glaringly evident whenever you zoom out on a much higher time frame. This is log and this is linear. Heck, it even matters whether or not you check the box to adjust your charts for splits and dividends. If you recall in one of my previous videos, I said that strong impulsive moves, like what we saw right after the election, often lead to the creation of symmetrical triangles as the market digests the move. And I find it fascinating. Look at this on the RSI. What do we have? A symmetrical triangle. Sometimes you will see a geometric pattern that forms on the RSI, but not on the price on the chart, or vice versa. And we can see that essentially the same pattern has also formed on SPY. And this is honestly one of the reasons that I just love the simplicity, yet the usefulness of the RSI, because it can often clarify where support and resistance actually is. And it's almost like peeling back the veil on the market. In case you missed my last video or you haven't had the chance to look at it yet, I want to remind everybody that the market right now, SPY and QQQ, appear to be in these ascending channels. It is crucial. It is so important to find out whether or not SPY can break this main resistance line. If it cannot, it should force it out of this channel. Now keep in mind, there is this main previous resistance, now possible support line directly below it. And where we saw weakness in the tech sector last week, QQQ actually broke support for a day, then clawed its way back up into it, but it's actually right below this resistance right now as well. The number one thing to remember is that you have to be open to the possibility of being wrong. If price action develops that invalidates your hypothesis, i.e. price blasts through what you thought was a key level without hesitation, it may be time to go back to the drawing board. There's always the possibility the market just got ahead of itself and it's about to have a big rejection once momentum slows, but it's also quite possible you just charted wrong. Do you want to be right or do you want to make money? And if your charts are right and you're risking capital properly, you should be making money. Let the charts speak to you. Don't tell the charts what you want to see. And I want to quickly point this out on Nvidia. If we view this as a massive rising wedge, then it is dangerously close to its apex. As I've covered in previous videos, the breakdown target for this rising wedge would have Nvidia coming down to about $70 a share. I'm about to share this week's trading rule to live by, but just a quick reminder that nothing I have said is financial advice. You should always do your own due diligence. I want to wish everybody the best of luck this week. And without further ado, this is this week's trading rule to live by.